Hey everyone, welcome to this video where I'll walk you through how to audit a trial balance. Auditors use work papers to document the purpose and procedures of their audit. In this example, I've created a work paper from scratch. I started by noting the client's name, the, the document title, trial balance, and the date, which is 31st December 2024. This trial balance was created by the client, okay? And I performed a footing to check and ensure that all amounts add up correctly. So before diving into an audit, the first step is to verify the mathematical accuracy of the debits and credits, right? You want to make sure that this trial balance actually, the debits and net and the credits net off against each other. So you can see here, positive debits, negative credits, and same value. And when these balances are summed up, they give me a zero balance. So if I go here on my tick mark legend, I can say I reviewed the trial balance to confirm it nets to zero and tested its mathematical accuracy. No discrepancies were found, ensuring the trial balance is accurate and balanced. The next step is to understand the trial balance. So we can see here we have account numbers. We also have the description. So in this particular example, the numbering system follows a pattern. So the 1000s represents assets. The 2000s are liabilities. We can see here the 3000s are equity, 4000 revenue, 5000 COGS, and then overhead expenses in the 6000s. I try to add as many as I could. 7,000 operating income, 8,000 and 9,000 capture interest income and other income respectively. Understanding this structure helps in analyzing the trial balance efficiently before diving into detailed audit procedures, okay? So always start with mathematical check, debits, credits, balance, okay? And then understand what these line items mean. Each account in the trial balance must be correctly classified as an asset, liability, equity, revenue, or expense. So I've done that. And auditors must also check contra accounts like accumulated depreciation to ensure that they are in the correct format. Contra accounts reduce the value of related accounts, and they must be properly recorded to avoid misstating the financial statements. So you can see here that the trade debtors, an asset, debit, the contra account, credit. Same with the accumulated depreciation here as well. Okay. So I've just identified the contra accounts and I checked that they are in line with what they're supposed to be. And I can also I've identified the assets, liabilities, equity, revenue COGS, and expenses. And now we're gonna map the accounts to the respective financial statements. So next we need to map the accounts to their respective financial statements. So assets, liabilities, and equity belong to the balance sheet. You can see here. And then revenue, COGS, expenses, and other operating income are recorded in the income statement. So even if you're not an auditor, but you're just working in accounting and an accounting department where you are preparing financial statements every month, this is a good way of actually going through after you've done all the reconciliations, posted everything that needs to be done, processed the bank record, all that stuff for month end closing. Once you now have all the data and you're happy with the data, you want to do you get a trial balance, accuracy check, and then you can map it out. If you do not like the way that maybe the accounting software that you use or different divisions use different software, so you have a standardized template for reporting. This is one good way of doing this on a monthly basis. It helps you also understand your trial balance really well, understanding what's where and stuff. Now that we've done the mapping, we also want to further classify where these items are going to be in the balance sheet. So now that we've identified the mapping, we now have to say where will trade debtors go? And we know that we say, okay, according to the accounting framework that you use, you have to check. And I'm going with IFRS, so the line items, again, you have to remember current assets, the difference between current assets and non-current assets, current liabilities, non-current liabilities, and things like that. But ideally, I've already identified the items and things like that, so I'm able to say trade and other receivables will be trade debtors here, okay? And yeah, different items. I know share capital will be share capital in the balance sheet, retained earnings, and things like that. So revenue, COGS, other operating expenses, employee benefit expense. I'm just grouping them in a way. And if I'm doing this at month end, someone can the financial controller, the group financial controller, or the CFO, they can look at this mapping and say, oh, I understand what's making up current assets, even the CEO and things like that. They can see the basis of the preparation of the month end or year end financial statements and stuff like that. So after this, this is good practice as well. If you're just starting out an audit, this is good practice. Understanding trial balances, ask if you can get it earlier and try to do this. You'll find that most, like I worked in different companies, sometimes the trial balance is like 200 line items. It You being familiar with the client's trial balance, taking the time out when nobody's on your neck to finish a task, and understanding the basics like this, it really, really set a good foundation. And you understand the procedures, you start to learn to document what you're doing because I'm going to show you at the end how all of these procedures are going to be documented. So, yeah, now that we've identified where each line item is going to go and where it's going to go in terms of the financial statement and the description of that item in the financial statement, we are going to talk about materiality. So I'm going to switch over here. So materiality is a key concept in auditing. This is the biggest number an auditor considers important. If an error is bigger than this number, it could change how someone views the financial statements. It helps auditors determine the significance of an error or misstatement in the financial statements. Materiality is usually calculated as a percentage of a key financial benchmark, such as revenue, profit before tax, total assets, and things like that. So we can see up here. So there's some of the benchmarks, and that's the formula, the benchmark times the percentage materiality. And in this example, I've used 100K, the revenue, and 2%. And we get 2000 as our materiality. And then performance materiality is set lower, is a is set at a lower level than overall materiality. And I've chosen 75% of materiality, and we see here 1500. And then we have another thing called trivial materiality, refers to small errors that, whether looked at individually or together, are clearly too insignificant to impact the financial statements. So you can see here how the materiality, performance materiality and trivial. So if I find a difference of $100, I'm not gonna investigate and find that out because I do not, this is so trivial, it will not change the user's decisions on the financial statements and stuff like that. But performance materiality and this we have to investigate. And it also helps us understand which accounts we're going to test. Okay. So we can see here that all the accounts that have a minimum balance of $2,000 are going to be tested and stuff. And then some within the performance materiality will probably be tested maybe as a whole and stuff like that. But you know the ones you're definitely going to test. Here, going back to my tick mark legend, you can see that I identified the account type, mapped it to the appropriate financial statement line item, and determined whether the geo account will be included in audit testing. Okay. And to conclude this video, you can see here the purpose of this work paper is testing the accuracy of the trial balance and determining the accounts that will be tested as part of the 31/12/2024 audit. Okay. And the procedures that we took is we received the trial balance from the client and he set it below. Okay, in this work paper here, we calculated the total debits and credits to ensure they are equal, ensured all accounts are correctly classified, assets, liabilities, equity, revenue, expenses, verified that contra accounts are in the correct format, identified the mapping and financial statement line item of each account in columns J to K, J to K, right? And just going back here, evaluated whether each account in the trial balance will be included. Testings is column K, it's column L actually. So we do need to change that. And based on the procedures performed, we confirmed that the trial balance is mathematically accurate and identified the specific accounts that will be subject to audit testing. Okay. And yeah, so we can see here, if someone looks at my tick mark A, they see that I did the mathematical accuracy, and my tick mark B over there, that the procedures I've just mentioned here. If you are then in a finance department, account department, whatever you call it, it's so interchangeable, but ideally it's an accounting department, you are going to this you will not go into the materiality, but when you're preparing, you might prepare your financial statement, your income statement. You can prepare it analyzing by nature of expense. Again, this is all first analyzed by function of expense and stuff like that. You can do it. This is a balance sheet, and you can see how all these line items are working, how all of the descriptions that we were working with in this work paper, how all of these matter when we are now preparing the financial statements. You see the descriptions even here. You see what other expenses are and depreciation, amortization, employee benefit expenses, things like that. So again, always check that the total assets less your total liabilities and equity should be 0. And you can see the balance is 136, 136. So you know that, okay, now I can send this to my supervisor. And you can do different analysis with these financial statements. So for example, in the income statement, you can do a vertical analysis. You can do actual versus budget here. And you see the variance amount, the variance percentage, and then maybe you have to comment it. You have to provide comments on any variance that's more than 45%, whether it's a positive or negative. You need to understand what you're doing right. I think sometimes people always think a variance is all about what you're doing wrong, but you also have to understand what you're doing right. So then if you stop doing that, you can go back and say, we were doing this. Are we still doing this? No, we're not. That's how you identify what you're doing right and what you're doing wrong. So don't just make comments on variances where the items are just negative. It's a bad thing. Our revenue is not what it's supposed to be. But if it is, what are you doing right? You may need to come back and remember what you were doing right in case you stop doing that. Okay. You can do a ratio analysis and horizontal analysis as well. This is where you can calculate your revenue growth, seeing if your expenses are growing at the same rate as your revenue or they're growing at a faster rate and things like that. So different analysis and stuff like that help you understand your financials better and make decisions better for your business. I hope you found this video useful and not too long. Thanks for watching. Goodbye.